All right. It's time for the all-weather strategy discussion and review. Great to see everybody here. We're going to cover a lot of stuff. What's going on in global markets, what's going on with commodities, what's going on with oil, what should we be, thinking about as far as investing is concerned. So many things that we're going to cover in a short period of time. We're going to try to do this all in 1 hour. So I welcome everybody here. We're just getting everybody on the channel. I see Supergone says, cool, Andrew, glad to hear from you today. Wanting to get my view on commodities. We're going to hear about that. Yep. And gold. All right. Tar, thank you. Sawadee Krap, good to see you. And Singha, good evening. Good to see you too. Welcome everybody to this discussion. My name is Andrew Stotz, and I'm going to be going through the all-weather strategy. Remember, if you have questions as I go through this presentation, just type them in the chat. I'm going to do my best to try to answer every question. So as soon as a question comes up in your mind, write it down, and I'll do my best. Again, saying hi, Salia DC, Wadi Cop, good to see you. And Supercon says, seems that investors sell risk assets and hold US dollars, which would drive dollars super strong. Yeah, we're going to talk about that. We're going to talk about the dollar. We're going to talk about a lot of things that are going on. So why don't we get started, and I'll share my screen and start to talk about all-weather strategy a little bit, and then I'll be taking your questions. So make sure you ask your questions on the way through the presentation. Remember, the all-weather strategy is global, right? That's a big thing for it. Remember to ask your questions in the chat, and I'll answer them at the end. So we're going to review inflation and recession concerns, which are in focus, performance, which is on par with a 60-40 portfolio in June, and the outlook, the war in Ukraine, recovery demand, and supply chain bottlenecks to drive commodities and gold. Also, inflation quickly gets under control. Well, if that happens, then we're really in trouble with our commodities position. New lockdowns could hurt our equity positions, and central bank tightenings could just crash everything. Remember, this is important. I know it's painful to see losses in your portfolio, but remember, investing is a marathon, not a sprint. Do we have any runners in the call? I know some of you guys may be runners. I recently started running as a lady that I know. She runs every day, and I just felt inspired by watching her run. So I thought, I'm going to go out and run. So I've been running now for the last couple of weeks in the morning, first thing. So emotional decisions often turn out to be very costly. To avoid this, we stick to our FVMR framework. It doesn't always outperform in the short term, but in this, remember that we're in this for the long run. We're creating these strategies for many decades. There's me when I was a little boy. That's when I arrived in Thailand with all of my hair. And that's me when I'm 100 years old. Our aim is to create strategies that perform over many decades. That's our goal for all of our strategies available at Phenomena. Well, let's just go into the first strategy, the all-weather strategy here. And we are above traditional 60-40 still. We were 7.2% above the traditional 60-40 as of the 8th of July. The recent drop in commodities and gold has definitely hurt our performance. Keep this in mind. This is a great one that we like to revisit, which is the dilemma that central banks are facing. Inflation's too high, but we can't increase supply, so we need to reduce demand. That means a recession. This is what central banks are dealing with, and given the recent falls in asset classes returns, investors seem to believe that central banks are going to be battling inflation aggressively. And we've already seen the interest rates being pushed up by the central banks. Since the start of 2021, high inflation is transitory. That's what Powell said on the 30th of November. or actually since the start of 2021, and on the 30th of November, he said it's probably time to retire this world. Now, the Fed may be the root cause. The Fed has thousands of economists costing taxpayers billions a year, yet they didn't realize that printing trillions in money would create inflation. It would seem that most bubbles and crashes in my career were caused by the Fed. Absolutely. I totally believe that. Why do I believe that? Because nobody in their right mind would think that a committee of technocrats would be able to set the price of money. Yellen was wrong too. She said, I was wrong then about the path that inflation would take. And this is a smart woman. Treasury Secretary, Brown University, PhD from Yale. And she's saying that she didn't see. I was asked on a recent podcast how I overweighted commodities so early on. And I said that it was pretty obvious that we were going to have inflation. I could see it in my own business that prices were rising for coffee beans that we were buying. Yellen said, I don't think we're going to have a recession. Consumer spending is very strong. Investment spending is solid. There's nothing to suggest that a recession is in the works. That's unbelievable that she's saying that about a month ago. And what I have been saying is that I didn't expect the Fed to increase interest rates, and now they're increasing rates into a recession. Let's think about that for just a minute. I want to just mention that the Fed, if it's supposed to work the way the Keynesian people say it's supposed to work, then what you would have with the Fed is that they would be raising rates at the peak of the economic cycle. And if they did that at the peak of the economic cycle, what they would find is that they would be slowing down a fast-growing economy. That's Keynesianism. And when the economy is weak, they would be lowering interest rates to fire it up. But instead, they're doing just the opposite. The economy is weak, and what are they doing? Raising interest rates. It's like they're getting it wrong again, and they're actually causing the next recession. So this may apply to Yellen's statement about no recession too. Otto von Bismarck said, never believe anything in politics until it has been officially denied. The Fed and the Treasury face a trust issue. This was a funny meme posted by Elon Musk. The translation is, I swear to God, 8 years of 0% rates was really good, but inflation is average, so we need to hike 0.75. I'm not lying for real. Now, the Fed is trying to avoid taking responsibility. I think events of the last few months have raised the degree of difficulty, created great challenge. This is Powell. And there's a much bigger chance now that it will depend on factors we don't control. It's not in their control. Well, it's certainly in politicians' control not to have a war. They could stop this right now. America could talk with Russia and come up with a negotiated settlement, which they're eventually going to do anyways. So they let the war go on, and it causes massive scarcity, driving up prices and causing suffering. Now, Biden won't take responsibility either. He's telling the companies that are running gas stations, bring down the price you're charging. Come on. When has a president done this type of behavior? Biden tries to put the responsibility on the gas stations for their high prices at the pump. An ironic remark from a meme account hits the spot. Thank you for this tweet, Mr. President. My local gas stations all dropped their prices $2 instantly because they had your tweet notifications on, which of course is being sarcastic. They didn't move at all. In fact, businesses don't like being told what to do in America. So let's look at the performance of world stock markets. The US fell significantly in the past month, and China has continued its rebound. Key European markets fell a lot as well. Remember, if you want to get that table, just go to valuationmasterclass.com resources and you can download it. So let's review our asset allocation. Our asset allocation is 25% equity, 25% bonds, 25% commodities, and 25% gold. That is the most defensive that you'll probably ever see the all-weather strategy be. And we've been there for a while, and we're not rebalancing until September. So I'm going to take a break here and just see that we've got some more questions. Tar Kitisak has a question. Also, Tanat X has a question. Keep your questions coming. I'm going to try to answer all the questions that you type in or put down there. All right, let's continue on. And you can see that our regional equity weightings is also pretty much the most neutral that we've been. Remember that the U.S. is massive compared to the other markets, so it's really underweight the U.S. right now. We make no changes to regional allocations in this performance review. Our next revision is in early September. Let's look at the strategy's performance in June. World stocks have taken a hit in 2022. In 2021, they were up 19%. So far, year to date, they're down 20%. And in June, world stocks fell 8.4%, a significant fall. U.S. equity fell by 8.3% in May, and we had a 5% target allocation to U.S. equity, which was the third worst performing equity. Recession worries weighed on the U.S. stock market. Europe was the second worst performer, and they've already been performing poorly. So you can see the red line here. The U.S. has been performing very well. We had a 5% target allocation to developed Europe equity, which was down 8.4% in June. Worse confidence and economic data, high inflation, and ECB's desire to hike rates led to a fall in European stocks. The fact is, Europe is in serious trouble. I just want to change my camera here to be a full view. I'm not sure how to do that, but hopefully I can speak without the PowerPoint on. And I just wanted to talk about Europe for a second. Europe is in serious trouble. And people ask me, when would you switch to be overweight Europe? I would say not yet. There's still much more to come. In fact, Europe is like a powder keg ready to explode. Right now, as we speak, Russia is cutting off gas for maintenance on its pipeline, and it may or may not come back on. The point is, Germany is in serious trouble, because if they don't get that gas, they're not going to get it from anywhere else. America's not going to be able to ship it to Germany anytime soon, and Germany doesn't have the infrastructure to transport it. So Germany in particular is going to be in serious trouble. That gas is going to industry first, and then individuals second. German industry is going to be destroyed. And if they don't get the gas in the second half of this year, that could mean a huge wipeout in profits and revenues. Who's going to pick that up? Well, probably China. Manufacturing in China is probably going to pick that up. But Germany is going to seriously struggle. All right, let's go back to the PowerPoint. I'm going to highlight a couple of other things. China alone couldn't hold up emerging markets. We had a 5% target allocation to emerging market equity, which was down by 3.8% in June. Besides China, most emerging markets fell heavily in the past month. And Asia Pacific ex-Japan fell by 5.8% in June. We had a 5% allocation there. And of course, besides China, Asian markets fell in June. And Japan was the best performing equity in June. We had a 5% allocation, and it was down by 2.3%. Let's look at the Thai money market, which stayed flat. Now, rather than global bonds, we had a 25% target allocation to Thai money market bonds, which was flat as expected. The main purpose of our money market allocation is downside protection. So you can see that we are bearish because we've reduced our equity position, and we've got a 25% weighting in bonds. It's a pretty bearish stance. Commodities, well, we have been having such a great time riding the commodity cycle. We have had a 25% target allocation to commodities, and they've been on a big bull run, but fell by 13.3% in June, a heavy fall. Only livestock within commodities. These are the 5 different types of commodities that are in the commodity fund. Only livestock, meaning cow, cattle, that type of thing, pigs, those things were up. Everything else was down. Now, energy is about 60% of the total weight within commodities, and that was down by about 6%. The Fed's rate hike in June aims to slow inflation, but could also lead to recession. Other central banks seem to do the same, and that's bad for commodities. WTI oil closed June at 106 per barrel. Now, we've had a super strong dollar, and that means that commodities and other hard assets like gold tend to be weak. Think of it this way. Let's take the Thai baht. Is the Thai baht weakening or is the dollar strengthening? I think you could say that the dollar is strengthening. So is gold weakening or is the dollar strengthening? I think you can say that gold is not weakening that much. It's just that there's so much strength in the US dollar. So gold kept up pretty well in June. We had a 25% target allocation to gold, and it closed the month down by about 1.9% to $1,870 per ounce. So here's the all-weather strategy right here. And basically the best performers was bonds, where we had a 25% allocation. And the second one was gold, where we also had a 25% allocation. Unfortunately, we also had a 25% allocation to commodities, and it was the worst performer. All right, so AWS has shown strong performance. Except in the past month, AWS has had a higher return and a better risk-adjusted return in all periods. The same holds true for the drawdown adjusted return, but it has been the same in the past 1 and 3 months. So it's been a bit of a tough month. We weren't able to outperform 60-40, but from my perspective, if we look at a risk-adjusted return basis or drawdown adjusted return basis, we can see that we did okay. AWS has experienced less volatility, and mostly its 25 to 65% target weight for equity has reduced the volatility. And since gold is generally uncorrelated to equity, it has reduced the overall AWS volatility. It's important to remember that bonds, when equities crash, bonds can rise. And when equities crash, gold just could do anything. In other words, there's no strong correlation between the stock market and gold. And the result of that is that makes it a great diversifier. And that's why we hold it. Now, AWS has lost less on 9 out of the 10 worst days. And you can see the most recent worst day was the 13th of June, 2022. And the market 60-40 was down 2.2 and AWS was down about half. So it's still working. We're trying to protect that downside. So we try to lose less in down markets. And basically 90% of these days, we were able to outperform the market on the downside. Now, AWS has outperformed 60-40 in 65% of months. That's 26 out of 40. So before I continue, I'm just going to remind you to ask your questions. I'm seeing questions coming in. Supercorn has a question, and PPSS Sock has a question, and Supercorn has a question. What's your view on World War III? We're going to come to these questions. This is an interesting, who will be next president, Mr. Trump or Mrs. Kamala Harris? Oh, I have opinions about that, and I'm going to bring them to you in just a bit. But for right now, I'm going to unshare that, and I'm going to go back to the full presentation. So recession worries are in focus. If they're trying to slow down inflation, it also means that there could slow down the economy. That's how you slow down inflation, is you slow down demand. So they're naturally trying to cause, to some extent, a recession. Most big central banks are communicating that they're going to get inflation down. Investors seem to be buying the rhetoric. We still think central bankers and politicians will change course and return to loose policies as soon as something breaks. As soon as, for instance, the bond market or the high yield bond market starts to break, then the Fed is going to change policy. That's my view. But we stay defensive on equities at 25% target weight in case they just continue to crash. Soft landing is Powell's goal. As the Fed hiked rates by 75% in June, Chairman Powell reiterated that he thought it would be possible to stifle inflation and avoid a recession. On the other hand, his track record hasn't been great when it comes to being right. And that's why I'm worried when I hear Powell as well as Yellen say that there's not going to be a recession. I think there is going to be a recession. Now, since March, market expectations have shifted to a much more aggressive Fed. You can see that March is the dotted line and July 12th is the solid line. So expectations for interest rates or for the Fed to increase rates has continued to rise. In fact, what's interesting about this, I'm going to grab my pen here, 1 second. What's interesting about this is that the gap here has definitely widened. And here it's widened kind of less. And that basically means a flattening of the yield curve. And what's probably coming next is if they can increase short-term rates, then you could have a yield curve inversion. But that would be the Fed pushing up the rates. Now, where does the market think that this is going to be? Well, market thinks that by the end of this year, the Fed's going to be at 3.5%. Keep in mind that just in March of this year, they were thinking that it was only going to be 2%. So expectations of interest rates rising are high. So ECB targets a soft landing too. ECB is talking about an anti-fragmentation tool to battle inflation and avoid a recession. Fragmentation refers to different borrowing costs for member states. Like when high debt nations have high borrowing costs. So if ECB wants to support Italy, it'll buy Italian assets. But it will also sell some other assets so that the total liquidity doesn't change. In other words, they're saying it's not QE. So this is one of the scariest things that I've seen in a long time. I'm going to come and talk to you full screen. I think I just pressed that. There we go. So I just wanted to talk about this for a minute. What they're saying is that even though Italy has a higher level of risk, as an example, they won't have to pay a higher level of interest compared to other countries that have lower levels of risk. This is crazy. Why is it crazy? It's crazy because this is the whole soul of capitalism, that you have to pay a higher rate if you're a higher risk, and you get to pay a lower rate if you're a lower risk. So I don't like that at all. Whoops, there we go. And so that's the reason why I really don't like what I'm seeing coming out of ECB at all. And eventually, this type of subsidy will end up in tears. The ECB says to hike rates too. The Eurozone saw inflation rise to 8.6 and weakened economic sentiment in June. ECB has communicated that a hike is to be expected in July and then another in September. But imagine Germany is already being crushed by higher energy prices and energy scarcity. If they raise rates on Germany, it could be a final blow. Tightening could lead to a recession in Europe, especially with its ongoing energy crisis. America doesn't have that energy crisis. So we keep a target allocation of 5% to developed equity in Europe. Now, the Bank of Japan wants to keep rates low. This is the CPI or inflation for Japan. Bank of Japan is the only large central bank that doesn't worry about inflation. BOJ is certain inflation is transitory in Japan. The central bank wants to keep the yen weak to support exports, so they're letting inflation run hot. Keeping Japan equity allocation at 5%. You know, I was thinking about it today. I was taking a walk. I was thinking about when I first moved to Asia, Japan basically had just hit its peak. It was a extremely expensive stock market, and extremely, if anybody who's my age on the call knows, to go to Tokyo was a very expensive thing to do. But about 5 years ago, I went to Japan, and what did I find? It was cheap. Noodles were cheap. Hotels were cheap. In other words, things had gotten back down. Now, if the Bank of Japan had not intervened when the market went racing up, if they had not intervened and they had just let the market crash, what would have happened? People would have gone bankrupt, companies would have gone bankrupt, but it would have cleaned itself out. And new companies and new individuals would have reinvigorated the economy. Instead, what happened is the pain of deflation of the stock market, of asset prices, lasted decades of pain. So that's what's happened in Japan in the past. Now, strong US dollar hurts emerging markets, particularly emerging markets that are borrowing in dollars. In the 1997 crisis, that's ultimately what happened, was that Thai companies were borrowing in US dollar, but they were earning revenue in Thai baht. And so they couldn't manage that. Now, Fed actions are likely to result in a stronger dollar and less global liquidity, which could hurt the emerging markets. US dollar is considered a safe haven. It can strengthen further as a result of global turmoil. Right now, you have a couple different issues, but you have a flight to safety in the US dollar. You have destabilization happening around the world, particularly with food and energy. And then you have a very tight euro dollar market where it's hard to get dollar liquidity. So we keep our emerging markets at 5%. China alone can't pull up Asia. China's heavyweight in the emerging markets and Asia Pacific indices is, significant. Still, China alone hasn't been able to pull up Asia in recent months, even though China's been bouncing back. We keep Asia ex Japan at 5%. And bonds, well, we have a 25% allocation there, and we want to be defensive. Our allocation is to the Thai money market. So a Fed or other central banks rate hike should have minimal impact. If we were to see rate hikes in Thailand, short-term paper is typically less negatively impacted due to shorter duration. Also, energy prices are high. We've seen them come down slightly, but not by much. Europe's Russian energy dependence is going to continue to influence the energy markets. We think energy prices are going to stay high. Even if the war stops, we still probably have high energy prices. Now, one of the things I would say about energy prices is that if the Republicans get into power in the House in the November election, it probably is going to bring oil prices down because there'll be more drilling allowed. So oil price could go up further if we adjust for the money printing. Here's Macro Alf. I just recently listened to a podcast of him talking. The highest oil price ever was $147 per barrel in 2008. But oil is denominated in fiat currency, and there has been a lot of spendable money printing over the past 15 years. If you think the market gets extreme as 2008, the equivalent oil price in today's US dollars would be above 250. So basically what you could say is that oil may have a long way to go. The other problem with oil that we face is that the oil companies are not really allowed to do new exploration. They're under so much ESG pressure. I'm sure all of you have, heard about ESG, maybe try to invest in relation to ESG, but trust me, ESG has its downside, and one of them is what's happening to the oil industry. Now, you may say, well, that's the point of ESG, is to stop the oil industry. Yeah, but did you stop driving your car? Did you stop using your air conditioning? You didn't. So ultimately, it's demand that has to stop in order for ESG to work. You can't just pressure companies all the time. The demand has to slow down. And until demand slows down, the talk of climate change and climate activism and sustainability in businesses, well, until you start walking to business, until you stop using your air conditioning, you can say that not a lot's going to change. All right. So Europe's energy crisis is real. Other parts of the world would expect energy problems too. Here's an excellent tweet. It says Germany's RWE's power mix right now is 70% fossil fuel. And he says reality beats satire. In other words, this is crazy. The energy producer, RWE, is Europe's third largest in renewables. And rate hikes and high energy prices may have reduced demand. Still, news headlines from around the world warn of power outages this summer. But the key thing is this. What you can see here, I'm just going to grab my marker wherever that marker is. It's up there. And you can see right here that lignite, which is coal, and gas is what they're using. So that is the renewables. Here we can see the renewables up above. Solar, run of river, storage, biomass. Okay, wind onshore at 13% is the biggest one that is a renewable, but everything else, the big ones, are coal and gas. Now, OPEC has said it will increase supply, but hasn't met the production targets for long. In fact, Macron was talking to Biden about this. So here is Tracy, Chi Girl. Does not matter if they raise quotas, if they cannot hit them. OPEC output, again, misses targets in June. Now, the Ukraine war is disrupting supply. Probable further supply shocks expected. And energy prices can also remain high. And Russia is obviously an exporter of metals and food and other types of soft commodities. And a reopening of China could lead to increased demand for commodities. This is just as shocking as the first time I saw this. World Food Price Index hit a record 160 as far as the index is concerned in March, and it's still at 154 in June. We are in a food crisis. Russia and Ukraine account for 15 to 20% of the global exports of corn and wheat, and export bans on food in countries like India and Indonesia could exacerbate food shortages and push prices further. High energy prices feed through to food. Here we can see food prices, and what we're looking at is meats, that's the red line, and cereals, which is the blue line. Natural gas is used in fertilizer, and higher fertilizer costs leads to higher grain prices. You could stop using fertilizers on your farm, but your output is going to fall significantly. This is part of what's killing countries in Africa because their currencies are devaluing, so it's already expensive to buy things from outside the country, but they need to import natural gas or natural gas byproduct as far as fertilizer is concerned, and that's getting more and more expensive, but even worse, it's just getting scarce. That is why there's going to be an explosion in famine in Africa. That's a big prediction from my perspective, is that we're going to see a showdown between China and America in Africa. Corn is a primary input for feed grain of livestock and poultry, driving up meat prices. Now, commodities we think are set to go higher. We have a 25% allocation. Demand for necessities, supply chain disruptions, the war in Ukraine, all of these things we think are still going to drive the asset class higher. Now, you could say, what, Andrew, commodities is falling right now. Yeah, and it may bounce back. Even if it doesn't bounce back, the point is that we rebalance our portfolio every 3 months. Even though people around me are freaking out and feeling like they've got to get out of this and get into that, and then they got to get out of that and get into this. My whole objective is to have a framework and a structure and a time frame, and that's what I do with our FVMR. So in September, we're going to reevaluate that. What about gold? I got to turn on my air conditioning. It's burning hot. And how does that impact the demand for energy, right? We're all turning on our air conditionings, driving our car. Look at the traffic outside. Everybody's sitting in traffic. There's all kinds of pollution happening there. And everybody's in their cars saying, oh, ESG, we want to invest ESG and be good. Well, ESG, ultimately, if we want to save our environment, it's about a reduction in demand. So gold in our portfolio is insurance. Our target weight is 25%. And the war in Ukraine spurs uncertainty, and inflation expectations could rise, making gold attractive. We're not trying to pick the next upcycle in gold, but we see that the correlation between gold and equity is very neutral, and therefore we see it as insurance. though expected rate hikes and recession concerns are negative. Now, let's look at the risks, and then we're going to wrap up and take questions. Inflation could quickly get under control, and then commodities would no longer be attractive. The strategy is positioned to benefit from rising inflation through commodities. A quick resolution of the war in Ukraine would ease the pressure on energy prices. Weak Chinese economy could reduce commodities demand, leading to lower prices. And Republicans winning the House may lead to new drilling and therefore increased supply, and the price of oil could fall. Other commodities could fall with energy prices too, as it's part of the production costs. Another risk is global recession pushing down stocks. New COVID crap. We've also started to see indications of economic slowdown. In other words, what Janet Yellen and Chairman Powell are saying, that there's no recession, it's already starting to show up. And then there's central bank tightening, which could crash markets. If major central banks would surprise and be too aggressive with rate hikes and QT, it could crash the markets. And since the U.S. stock market usually has a global impact and U.S. dollars is a reserve currency, the Fed decisions typically have the most impact on global markets. Now, I just talked to you for a minute about this. One of the things that I would say is that basically, what is quantitative tightening? Quantitative tightening is that the Fed starts selling, not buying bonds. When they buy bonds, they give cash to companies and to the government. But what quantitative tightening is they're actually going to start selling bonds. And that means they're going to receive cash. They're going to give the bond, they're going to receive cash. When that happens, they're pulling cash out of the system, and they're no longer the buyer of the bonds. So when the U.S. Treasury has to issue more bonds because it's spending way more money than it's raising in taxes, where's it going to get the money? Well, the buyer of last resort is the Fed, and the Fed has been buying up to this point. So as soon as the Fed steps back from buying, in fact, they start selling, who's going to buy? Japan? Probably not. Europe? Probably not. China? Definitely not. So the fact is that the marginal buyer is not really there. So if the Fed does quantitative tightening and tries to get out of buying U.S. Treasury bonds, how about mortgage bonds? The Fed has been buying mortgage bonds too of houses. If they get out of that and they start coming back, who's going to be the buyer? There's not going to be a buyer. And that's the reason why, it's one of the reasons why I think that what's going to happen is that the Fed is going to have to reduce course and not be able to do quantitative tightening. All right, let's go back and wrap up the presentation. Then we're going to open up for questions. So what are the key takeaways? First, AWS was on par with a traditional 60-40 in June. The war in Ukraine, recovery demand, and supply chain bottlenecks should drive commodities and gold. And then there's risks of inflation getting under control, new lockdowns, central bank tightening, crashing markets. So before the Q&A, just to remind you, our next 6-week valuation masterclass bootcamp starts on July 25th. And if you sign up before 15th of July, you'll get my Achieve Your Goals course, which is a value of $147, and you'll get it for free. All you have to do is use this coupon code and say Phenomena. Would love to see anybody that wants to learn more about valuation in there. So it's question time. Let's move into our questions. All right. So I'm going to move into the presentation, and let's go back to the beginning and let's look at some of the first questions that we've got. All right. First questions. First question comes from Supergone, who says, it seems that investors sell risk assets and hold US dollars, which will drive the dollar super strong. Yeah, but maybe that's already happened. Is it really going to push the dollar up to 110, 120? It's possible, but I would say that's a pretty extreme move. Already moving this far is pretty significant. The fact is, it's almost impossible to call that right as far as what's happening with the dollar. You are facing, I think, a tightness in the euro-dollar market in Europe, and therefore, you are getting demand for dollar that outstrips the supplies for dollars. So yes, the dollar could remain strong, and hence oil and gold as examples would be weaker. So, but to be super strong, well, we've already seen a big move. Next, Todd Kitty Sock says, what will the economic signal to tell us the bottom has passed? Well, I would say that first thing you're going to watch for is that the market falls another 20 to 40%. That, to me, would be a bottom. A bottom is when things start to look cheap. A bottom is when nobody wants to buy. A bottom is when all the news is negative. Once those things are there, I would say we're getting close to a bottom. But are we at a bottom right now? I doubt it. Now, one of the things that's critical about capitalism to operate, a lot of times when we look at the economic cycle and the stock market cycle, we think that a crash in the economy and a crash in the stock market is bad, right? But is it? Some economists say, no, it was the bubble that was bad, where people that didn't really know what they were doing put their money into different investments. There was just too much money coming into the economy of amateurs, and then they got wiped out. And the fall in the market and the fall in the economy is the cure. I have to say that I was talking to one of my students the other day, and he talked to me about how he borrowed 800,000 baht from the bank, and then he bought crypto, and he ended up losing it. And the problem is that if somebody bails you out and helps you to make your payments, you never learn your lesson. And so I'd say that the U.S. in particular has never really learned its lesson, because the Fed tries to come in and save it all the time. So, all right, let's continue. Tanut X says, who will be the next president, Mr. Trump or Mrs. Kamala? I think neither of them will be the next president. The next president, in my prediction, is Ron DeSantis, the governor of Florida. I don't think that Kamala Harris is going to be able to survive the pressures from within her party, the Democrat Party. They want to eat her alive. The only way that Kamala Harris ends up being president is if Joe Biden is either incapacitated or dies. If that happens, then Kamala Harris will step up as the president from the vice president position. But if Joe survives, then she's going to remain a one-term vice president. And it will be Ron DeSantis, in my opinion. All right, next question. Kitty Sock, is there only one way recession? Is there only one way recession to decrease inflation? Oh, well, ultimately, what you think about it this way. The prices of goods and services are a function of supply and demand. These supply and demand factors, the beauty of capitalism is that many different players are always assessing the supply and demand and trying to adjust for that till the supply and demand come to an equilibrium. And at that point, we have a market price. So if we look at this, the way that you bring down inflation is, number one, you're trying to bring down prices. So if you can slow down demand, then prices will fall. Or if you can bring more supply of goods out into the environment, then prices will fall. Those are the two ways to do it. Now, the Fed doesn't control the supply of goods and services, but the government does, and they particularly damage the supply of goods and services when they shut down the economy. So my answer to that is yes, there are two ways that we could decrease inflation. One is to decrease the demand, which is what the Fed is trying to do. And the other one is that companies increase supply. All right, next question. Supercorn said, so the Fed has hidden agenda to keep U.S. dollar strong and raise rates fast, will hit many countries and they need money from IMF. Then the U.S. can buy cheap assets in many countries. Actually, the other day I had a visitor at my house, and he was a very nice older American man. And I asked him what he did and where he grew up. And he told me that he grew up in Southeast Asia. And then he told me that his father worked for the CIA. And he told me a lot of interesting stuff that, I've learned a lot about the CIA and the manipulations behind the scenes. But I asked him, what's the end game, do you think, from your perspective about America? And they said, to bring misery to the world. And the fact is that I'm not convinced that the US wants to buy cheap assets so much and keep the dollar strong so they can buy a lot of assets. I don't think that they're doing that. I think that they are bringing misery to the world. I think that was very true. And I suspect that they think that they're doing good and they're bringing goodness to the world, but instead, through allowing this war to go on by the strengthening of the dollar, it's bringing misery to the world. And yes, the countries will have to rely on IMF, just like Pakistan, just like Sri Lanka, and many others that could come. All right, next question. PPSS Sock says if EU is in serious problem, any reason to keep EU 5%, or do you expect boycott to stop soon? Okay, this is an important question. Why would you keep it at 5% if you think that it's going to go down? Because I also know that I can be wrong. So when I'm managing all weather and other strategies, although I will tilt towards my strategy, I won't tilt completely to my strategy and say, I'm not going to own any Europe, I'm not going to own any US or something like that. So the reason is that I would say that. Now, within AWS, we also, to prevent ourselves from overreacting, we keep a minimum allocation of 5%. Because what if I'm wrong? And Europe has been beaten down so bad that in the next 2 weeks, Europe starts to fly. At least we have some position in Europe. All right. Next question. Supergon says, what's your view of potential war expanding to World War III? Well, I think that one of the things that I have been writing about, and I haven't made it so clear, but I would make it very clear here, is that I think that World War III already happened. And that was between the US and Europe. And now the US has complete control over Europe. And with that complete control over Europe, the US can get Europe to do whatever they want, particularly cutting Europe off from Russian gas. And now Europe is under the thumb of America. And if America wants to go to war against China, as an example, they now have Europe on their side. They don't have Europe doing any side deals or anything like that. So, all right, let's continue on. Last time you told that you review Vietnam. How does your view on Vietnam as well as India? So as of right now, I haven't changed my view on Vietnam, but my view on India has also not changed. I have been positive on India because it's a less correlated market to the US, but also just because things have been going well. As far as Vietnam concerned, I have still remained neutral, not ready to bring it into portfolio. Supergon says, easy way to stop inflation is to stop support war. Why they not do it? It's because this is not a war between Russia and Ukraine. It's a war between US and Russia. And US has been working for decades to try to destroy Russia. And now they see their chance. And so the point is that there's no reason why the US is going to stop. They're going to get as many countries on their side, Europe's on their side, and they're going to continue to keep the pressure on Russia. And rather than stopping this war, sitting down, negotiating, they are going to keep killing people, and people are going to die because of not only US, of course, Russia is the aggressor here, but they were goaded on by the US for many, many years. All right, gold is insurance and G-bond is cash for opportunity. Yes, that's a good way to think of it. All right. Remember, you can join the Valuation Masterclass Bootcamp. Hopefully, we'll see you there. Next question. Supergon said, between war and Fed QT or raise rates, which one will impact more to the world market? Well, war is always going to be an extreme event. And also, we know that when war happens, inflation skyrockets. So inflation will rise substantially if we have a war. All right, next question from Nana. How do you like EV car stocks in US and China? Good to invest now or never, as opposed to challenging ESG you pointed out today? Well, ESG, first of all, E, environment, S, social, and G, governance. Governance, let's separate that out. Companies have a governance issue. And who is the governance issue to? It is to the shareholder. So let's separate that from ESG and talk about ES, environmental, the way we treat our environment and the way we treat people in society. This is not the role of capitalism to decide these things. It is the role of democracy or government to decide these things. Putting these things into the hands of capitalists and asset allocators is what we call a devil's bargain. You're bargaining with the devil. If Thailand, as an example, wants better environmental policies, it must pressure the government to do it. If the government doesn't do it, to turn to companies and think that they're going to do the right thing for all the people is not going to work out good. So be careful about ESG, mainly the problems that it presents. There's many other problems that it presents, but that's the one I would mention. But now let's go back to EV. I don't have a problem with electric vehicles, and that's good for the environment. But of course, it may not be. Where are they getting their rare earths? How much do they have to dig out of the ground to get that? How much energy is being used to actually create that car? There's many, many other issues. But if you like electric vehicles, you like to buy the vehicles or you want to buy the stocks, I think there's nothing wrong with that. I wouldn't say that my opinion on ESG changes that. All right. So next one is, what is that? Samri. I don't think I pronounced that right, but that's my reading of it. Hi, Andrew. Thanks for a great live. I have some questions about false breakout. It's false breakout. It came from institute, like big guys, to make liquidity order for them. It could be real. Yeah, there's definitely some huge players in the market. I mean, the Fed is the number one player in the market. And when they speak, the markets move. But there are some other bigger players in the market who could be putting some moves on, putting some trades on, and that's causing a false breakout. It's very possible to see something like that. It's not easy to sustain because markets are very liquid. It's not like in Thailand where you could manipulate a small stock, but manipulating the whole market, and particularly the US market, is actually very difficult for a sustained period of time. All right, Saburo says, I hear in present some of institute funds are using robotic trading in the future. If all institute funds use robotic trading, it's still possible to use technical analysis to make profit. Yeah. The first thing that I've learned about AI and robotic trading is that it's not a complete substitute for humans. It is a partial substitute for some tasks, but humans are still have a way big competitive advantage in this space. But what I would say is that if everything goes robotic, then you're going to have more chance to outperform as an individual investor because there's going to be opportunities. So just as much as we may see AI have a more and more influence, basically the market is a complex system and it's self-correcting. So if an AI system starts doing really well, making money, other people are going to create the same AI system. And as they do that, the opportunity to make money on that particular area that they're trading on goes away. It's a self-correcting system. So it's not that easy to consistently make money through AI. So technical analysis can still work. Sararat says, why don't you have China instead of Asia x Japan? Well, it's nice to think that you could call China right at the bottom and get into China. But remember, all-weather strategy is not going down to the country level. We have regional allocations. We do have country in the US and Japan just because they're not part of some of the other indices. So we have the US and Japan are the two only single countries. The rest of it is regions. And that's the reason why we don't go down to China. We do have our alpha focus strategy where we are trying to go down into different countries. And as of right now, the momentum is just not enough right now in China for us to be interested. So next question, Tar says, which asset class or which market will raise after recession? Well, the problem that you face is that when the recession comes and things start crashing, people tend to want to buy high quality companies, but a lot of times it's the low quality companies that outperform in a recession. In other words, as a recession ends and they survive, but they're relatively low quality, everybody thought they were going to go bust. And as a result, what happened was that those countries When those companies turned around, everybody was positively surprised. And when that happened, they flew. So a lot of times what happens is when a stock market's falling, investors tend to want to get defensive. They get defensive at the bottom of the market when they should be actually aggressive. So that's what I would say. As far as asset classes and the like, I would say things like banks, as an example, should do relatively well. Equities should do relatively well. Bonds don't do that well because they're not capturing much of that upside. Commodities may do a little bit well. And ultimately, so I would say it's stocks, commodities, bonds, and gold. That would be kind of the order, with really stocks being the main driver. All right. I believe this is the last question, unless I get any more while I'm talking. I see 173 people and lots of nice likes and loves. I appreciate that. It's really exciting to come here and talk to you about what's going on and take your questions. They are tough questions, and I'm thinking about them as much as I can. So Monica Sao says, what's your view on the new world order led by BRICS countries and the new currency competition with US dollar? Thank you very much. So Monica, this is the whole thing that really the Biden administration is doing. They're actually destroying the dollar by using sanctions against Russia and threatening everybody to go along with them and trying to get everybody in. If you're not cooperating with them, like Russia, or if China doesn't cooperate with them, then basically they're going to cut them out of the dollar system or the SWIFT system, as an example. And the reality is when you use your club that you have, that's the US dollar, you start to scare people. So the US government and the policies of the Biden administration is actually destroying the power of the dollar and encouraging countries in BRICS, as an example, to set up their own currencies. Now, it's going to be difficult to do because some of the news articles that you may read say that a new currency could be based on oil or commodities. But hey, remember, India doesn't have any oil. So if India allowed a currency to be backed mainly by oil and hard commodities, they don't have much of that. So Russia would be the leader in that particular currency. So there's a lot of working out as to how that would work, but definitely those conversations are happening. And I believe that that's being caused by Biden's policies. All right. Jesus says, what's your view about private real estate funds? Some asset management companies have started to launch that kind of fund investing in global real estate. Well, the first thing is that a lot of real estate funds are just buying they're listed in the stock market and they're moving with the real estate sector. So basically you can buy a listed REIT that, that's a very, let's say could be valuable for dividends, and it's a very stable asset class. We don't buy these REITs because we're already buying them when we buy equities. So if you buy, let's just say you buy the SET index, as an example, or Asia X Japan, it already includes all the REITs in that index. And that's part of the reason why REITs tend to move in line with the market. So from my perspective, I would say I'm not too excited about REITs. I will sometimes trade them in the alpha focus strategy. All right. And what do you see Q2 US Bank earnings day? Is it going to be a positive? I think actually the US is in pretty damn good shape. Why? Because US banks, 40% of their balance sheet is basically risk-free, cash and government securities. They haven't been lending out that much. And so the result is their balance sheets are actually in pretty good shape. So it's possible that we could see a positive surprise on earnings. All right. I think this is the last one. And I see Tisa, good to see you. You got this. That's what she wrote. That's very nice. You got this. All right. I want to thank everybody. It's 8:01. I don't want to take more than an hour whenever I come on. So hopefully I can give you as much as I can in an hour. Hopefully you gain from that. If you have further questions, feel free to reach out. In addition, if you're interested in the Valuation Masterclass Bootcamp, you're certainly welcome to join, and I'll see you in there. Otherwise, keep calm, stay invested, don't get too extreme, and don't let your emotions take you away. This is what we're doing with All Weather Strategy, and I appreciate all of you. And I appreciate that you take time to listen to me talk and to ask your questions, and hopefully my answers can give you some value. So Salaya says, thank you. It's always good to hear from you and your opinions. I appreciate that. And I do like to come on and talk about it. In fact, after 30 years of studying markets, I love this stuff. So I hope everybody has a great evening ahead. Relax a little bit. Give your wife or husband a hug or your children a hug. Be glad that we're in a country that is safe. Be glad that we're in a country that has food. That's a critical thing. And enjoy every day. I'm going to go give my mother a big hug. Good night. Have a great evening.